So I'm just going to start recording this, and then I'm going to share my screen. Ta-da! So make sure I've got my hello. Okay, good. It is working. Nice. Everybody's up and running. We're all plugged into the matrix. Right. Why is that itch? It's never a good question. Okay, so the problem's up on the board again. I've created a little table here to kind of outline the three options. So the first option is no financing, like no bank financing. We're just going to use the $250,000 we have in the bank, okay? So we're gonna equity finance this project for $250,000. Our EBITDA from the question itself was $50,000 per year. Our income before income tax, our interest expense was zero because we didn't take on any additional debt. Our income before income tax is our EBITDA minus our interest. We didn't have any. Let's assume we don't have any depreciation as well. So it's 50 grand. Our income tax at 40% is 50 grand times 40%, which equals 20,000. So if we take our income before income tax minus our corporate income tax, we get a net income of $30,000. Okay, so $30,000, pretty good. You know, at least we're making money on the project, but we financed it 100% from equity. So if we look at this, we do some calculations here. Our profit margin is our net income divided by total sales. Where is it here? Where did I? Sorry, the sales for this project is 150,000. So we take the profit margin, or sorry, the net income divided by 150,000. We get 0.2 or 20%. So there's a profit margin of 20%. Let's see the return on equity, and to calculate return on equity, we take net income and divide it by our equity. Our return on equity is 12%. Our debt to equity in this case would be 0 divided by 250, which would equal 0. So it's 0 currently. And our interest coverage is 100% or is also 0. Sorry, yeah, because it would be our interest expense divided by our net income. So we don't have these. We have those ratios would be zeros because we don't have any interest, and we don't have any debt. Okay, so let's now explore the second financing option, which is 50-50. So 50% cash in the bank, 50% debt financing. So 50% of 250 grand is, that's not what I meant to do. Is 125,000. So you're going to use 125,000 of your own money and 125,000 of the bank's money. Always the zeros. Always the zeros. To get the total 250,000 that you need to finance this project. Your EBITDA is still 50 grand. However, you've taken on debt. Thus, you're going to create an interest expense. Your interest expense is 10% of your debt. So you take your total amount of debt, which is 125 grand, and multiply it by 0.1 or 10%. You get $12,500 in interest expense. Your income before income tax will be your EBITDA minus, why did that go away? would be your EBITDA minus your interest expense. So your income before income taxes, in this case, is $37,500. If we take, to calculate our income tax, we take our income before income tax and multiply it by 40%, which is our corporate income tax rate, and we get our income tax of $15,000 for the period, or for this project. If we take our income before income tax, subtract our income tax, we get a new net income of $22,500. So between the two options, which one has a better net income? Sorry? The no financing. However, if we look at a couple other things, so we take a look at our profit margins. We take our net income divided by 150 grand. That was not 150 grand. We get 15%.
Why is it 150? Okay.
Oh, it's just in the question here.
Ah, okay.
Yeah, because this project would increase sales by 150 grand.
Okay.
So we measure this as a standalone project. Our return on equity would be 22,500 divided by the amount of equity we have. So here's an interesting comparison. If you take a look at those two ratios, between the two options, our profit margin is going down, but our return on equity is going up. Our profit margin is essentially our profit as a percentage of sales, but our return on equity is how well, is usually a metric or a measure of how well management is using equity to produce earnings. So if we're seeing earnings, a return on equity increasing between the two projects, someone could logically go, okay, well, this is obviously a better use of equity because I'm getting a higher return on it. But if we move down another ratio here and we take our debt to equity, so our total debt in this case is 125 grand divided by our total equity, which is also 125 grand, we get a 1%, it's equal to 1, it's 100%. So our equity is the exact same as our debt. So we're equally leveraged as we are supported by equity. Okay, so this is neither good nor bad. This is fairly okay. If we look at interest coverage, we take our net income, divide it by our interest expense. We could, oh God, this is just general number. This would, there we go. We could cover our interest 1.8 times. How many, what's usually the cutoff for, what did we say the cutoff was for interest coverage? 1.5. So if interest coverage is 1.5 or less, people would start to be concerned whether you can cover your interest expense. In this case, it's above 1.5. This is good. And considering we're looking at this as a standalone project, it does not include the income of other activities. So this is us renovating a restaurant. This isn't including the income that we would get from the rest of the restaurant. Just the income that we would get from the renovation. Okay, so let's look at option number 3. 100% financing. You were like, I really enjoy logging on to Scotiabank online and looking at 250 grand in my bank account every day. So I'm just going to finance this all through debt. So you finance 250 grand from debt. your EBITDA is 50 grand. 1, 2, 3. And your interest expense is 10% of the amount that you borrowed, which in this case is 250 grand. It's 250 grand multiplied by 0.1. So your interest expense is 25,000. Yes, sir. Earnings before interest, taxes, depreciation, and amortization. Our income before income tax is our EBITDA minus our interest expense. Next, we have to calculate the income tax for this option. It's our income before income tax multiplied by the corporate tax rate of 40%, which is 10,000. So if we look at our income before income tax, subtract our income tax, we get a profitability of $15,500. Sorry, $15,500. If we look at profitability, we take the 15 grand divided by 150,000, which was the additional sales. 1, 2, 3. And we get 10%. If we return on equity, we can't, because we can't calculate that because we don't have any equity in this project. So it would be 0. Our debt to equity would be also 0 again because you can't calculate it. And the interest coverage, we take our net income and divide it by our income tax rate, get 1.5. So looking at these two options, a couple things scream in my head. Option number 3, which we just did, so financing 100% of the project with debt, is it profitable? Yeah. But there's other options we can consider that have a higher profit margin, so I don't think that's the best way to think of this. Because of the interest that we would incur on this particular bank loan, it's increased the interest expense so high that it's taking the interest coverage ratio down to 1.5. 1.5 or below is where people would be like, no, this is not good. So I'm not sure that option 3 is the right way to go. I mean, on the other hand, you know that you still have $250,000 in the bank, but this isn't just for right now. This is going to be reoccurring, right? So if something happens and there's a cash crunch, or you all of a sudden have to buy a new piece of equipment, you might not be able to pay your interest expense and have to put cash into the business. It's not very sustainable here. What we're trying to do is make a decision that is sustainable from one period to another. We're not trying to make a decision here and be like, this is fairly okay, but something bad could happen where I have to keep putting money into my business. That's not what we're trying to do. Option number 1, profit margin is better than all 3 other, better than the 2 other options, because the profit margin is 20% when compared to 15 or 10%. So evaluating the 3 options strictly on profitability, option number 1 is the way to go. However, the return on equity is low in comparison to the second option. Your return on equity is much higher in the second option at 18% opposed to 12%. You also, in the first option, you didn't take on any additional debt, so you're not incurring any additional you're not incurring any additional interest, so you can't really calculate your interest coverage here for the project, but you can in the second option, and it's 1.8. So you can reasonably cover the interest, which is good. If you think about, so let's automatically just like X-nay option 3, because that's not a good idea. So we have option number 1 and option number 2. Option number 1, if we financed, we used 250 grand worth of our money into this, sure, we would have a much better profit margin and what is it called, a fairly decent return on equity. But what this is doing is turning, where's my marker? Cash that you have into a renovation. Your cash is a current asset. Your renovation or your leasehold improvements is an asset, but it's part of your plant, property, and equipment, and that's not a current asset. That's part of your plants, property, and equipment, or your long-term assets. So if you're taking cash and you're reducing your cash, you're not touching your equity or your liability accounts. You would thus have to increase your, using double, using accrual accounting. To decrease an asset account, you would either have to decrease a liability or equity account or increase a different asset. So what this is going to do is lower your current assets and increase your plants, property, and equipment, or long-term assets. It's not going to change your liabilities. So if we look at our current ratio, our current assets are going down and our current liabilities are staying the same. As our current assets go down and our current liabilities stay the same, our current ratio is going to look worse because we're not as liquid. Same with our working capital. So your working capital equals your current assets minus your current liabilities. Now, assuming that your current assets are supposed to be more than your current liabilities. So understanding that, usually if you take your current assets and you minus your current liabilities, you're left with a positive number, whatever that is. Now, if we only finance this project with cash that we have, which is a current asset, we would be dropping the value of our current assets and keeping our current liabilities the same. This could take our positive working capital from a positive thing to, would decrease it to maybe even a negative number. Restaurants are super, okay, so working capital is the amount of money or the difference between your current assets and your current liabilities. This is the money that you have to fall back on in cases of emergency, in cases you need to place orders. It's just cash that you have on hand to operate your business. If you take $250,000 worth of cash in your current assets, turn it into a long-term asset or a plant or plant's property and equipment, you're going to be tanking your liquidity ratios, and you're also going to be tanking your working capital. And even though you, at this point, you have access to $250,000 worth of lending, so the bank is going to give you 250 grand worth of money. The reason they're going to do that is because you've got $250,000 in the bank in cash. Now, when you've done this renovation, you've turned this cash into a renovation, which is plants, property, and equipment. You've hurt your liquidity ratios and your working capital, which is what the bank would look to secure their loan with. After you've done that, the bank probably wouldn't give you a loan. Or they'd think differently than they did before about it. This is not probably the best option because while the profit margin is great and the Return on equity is a positive number, which is good. This isn't the best option because you're going to be tanking your liquidity ratios, your working capital, and this could affect your ability to secure financing in the future, which is important for restaurants. Trust me, you can get financing. Especially when we go back, remember we were showing that like financing in restaurants is between 60 and 90%. You will need financing. Does that mean that you cannot absolutely do this? You can do this if you want. It's about risk, right? This is super high risk. Option 1 is super high risk, and you can, high risk is usually characterized by high return, right? Well, it's no shocker that in this particular scenario, it's got the highest profit margin. It's got the highest return. It's because it has the highest risk. Option number 2, on the other hand, and I think we've kind of identified it as possibly the best option as a process of elimination, through process of elimination. It has the medium profit margin. It has the best return on equity, which is a good thing because it shows how well we're managing our equity. It has a 50-50 debt to equity. It also has an interest coverage of 1.5 times. So the project alone by itself can cover the interest expense 1.8 times, which is more than the 1.5 cutoff. This is a fairly reasonable amount of debt, or risk, I should say. You're getting the best return on equity, and your profitability is still good. It's just less risky. Is it still going to hit your working capital and your current or your liquidity? Yes, but at half of the effect of option number 1 because you're only financing it by half of the original investment. So yes, your liquidity is going to change, and your working capital is going to change, but it's only going to change by 125,000 opposed to 250,000. So at the end of the day, after this renovation, you still have 125 grand in your cash. Yes.
So if you were to say finance 40 or 60%, that would adjust all the numbers.
Oh yeah.
So like, you ideally try to look at what the highest return on equity would be.
The highest return, and also the idea here was to look at return and kind of understand risk, but also understand how it's going to be affecting your ratios and how that would affect business operations in the future. So option number 1 has the best return, but because it has the highest risk, but it's also weakening a lot of your ratios. So your liquidity ratios, your working capital. It's also the weakest return on equity ratio. So, and this is just a very brief example of how this management decision-making process affects finances, financial statements, and ratios. What we did here, and like Karin was saying, you could have broken this down into all cash, no cash, 60% financing, 40% cash, 60% cash, 40% financing. Whatever you wanted to do, you could investigate and check out different scenarios. The reason we do this and break up different options for different scenarios, it's called a sensitivity analysis, is how sensitive is your profit, your ratios, your financial results on different scenarios. And later in this course, we get super freaky with sensitivity analysis. We don't just base it on differing investment proportions. We also base it on different sales levels, different cost of capital levels, things like that. So, and you'll see under different situations, a lot of this changes. It's also important to note that this was evaluating a standalone project. So you've decided you've done a renovation, you just don't know how to finance it. On the other hand, if you were deciding whether to renovate your restaurant or build a patio, you'd be picking the best option between you would be evaluating them as standalone projects originally, and then comparing them together to figure out which one you do. And to do that, we do a sensitivity analysis, project costs and revenues into the future, then discount them back to the present period, and whichever one has a net present value, or the best net present value wins, and that's the one we do. We don't do that now.
So this scenario is basically saying that you're going to be doing a rental restaurant while still operating business?
Yeah.
Okay. So what if you're just being different analysis? If you were to say shut down the restaurant for 6 months to a full, right?
Oh yeah, 100%.
Completely take out your AD.
Yep, 100%. All right, so I'm gonna stop sharing that there. Go back to this.